Dear friends, it's time to rewind our monthly videos that we've brought to you. We have put in a lot of effort, research, and the team at Alchemy has put countless hours to bring our insights, experience, and analysis so that we can simplify and decode the complex happenings in the economy, macro, sector, and companies.
And I think clearly the more domestic, so-called cyclical or investment-driven sectors are at the forefront of this rally. So whether it is capital goods, whether it is real estate, power, infrastructure, cement, renewable energy, electric manufacturing services, defense. I think these sectors have clearly shown, PSU banks, all these sectors have shown very good leadership.
Domestic cyclicals are the ones that have led the rally both in terms of price action and earnings growth delivery as well. So it is not just hopes. We are seeing the order inflows coming through, the order book is swelling. A lot of these sectors are actually led by the initiatives by the government. Given the fact that the government has the intent to do and the means because of a stronger balance sheet at the government level, we do expect that this rally in both earnings and price front could have more legs.
Coming to capital goods, a sector which has tremendous tailwinds, continues to do both well as far as the results are concerned, order books are concerned, and also stock performance. But now, I think pretty much with the end of the third quarter, we've seen that all the benefit of margin expansion, at least comparing it to the base of last year, is now recouped, right? So from here on, if we want to get a healthy double-digit returns or PAT growth, we will need both. We will need top-line growth as well as margin growth. And I believe that the reason why the top-line growth still continues to be very anemic is because the inflation impact in the base quarter still continues to be reasonably high.
So where we are today, I think our macro is at its best and we have a very stable government, and as I said earlier that there is a very high probability that this government comes back. And they've also articulated that as soon as they come back, they're going to take even bigger decisions, right?
That period was the 2003 to 2007 period, which was largely investment led. Most infrastructure, energy, P2B businesses did very well during that period. Consumer facing businesses did very poorly. So the next cycle was from the global financial crisis till the COVID crisis. COVID happened early 2020. So from 2007 end till about 2019 end was the exact reverse. Anything that did not work in the previous cycle was the success mantra of this cycle, and the ones that were the biggest successful ones failed here. Cycles changed again. Most of the parameters, most numbers post the COVID bounce back show we are in a much similar cycle to the 2003 to 2007. So where again infrastructure led, B2B businesses, Capex oriented stuff, governments resolved to have more and more Capex being done, those things are tiling up.
The best returns and outperform the market by a huge margin in financial year 23-24. Friends, it was the real estate sector. We don't talk about it much because much larger sectors tend to take a lot of our time, but we believe that this is a sector that we cannot ignore. And as we've seen in the previous cycle, not only in India but even internationally, that when that happens, the real estate sector booms. And we believe that we are in the early stages of that boom. So the question is that the current 2% share of real estate in the total market cap, where can it go? Well, directionally we are very clear, it's likely to go up. Now whether will it be 4%, 5%, 6%, we do not know. It really depends on how fast our per capita GDP grows. But let's say, for the sake of argument, if I were to say that, let's say over the next few years, it even goes to 5%, right? And the per capita GDP compounds at 10% a year, then real estate market cap has to go up at least 150% at 5% share. Now, whether it's 5% or 6%, as I said, only time will tell. But directionally, we think that there is a significant upside when it comes to where the market cap of the real estate industry can be over the next couple of years.
And if we look at the sectors which are really topping the charts, then, well, no surprises. The fastest earnings growth in the fourth quarter at a PAT level was from cap goods. The second best was autos and auto ancillaries. The third was infra, which includes real estate. And therefore, as we have been emphasizing for so long, that it is the more cyclical sectors which are driving earnings. And that is where we also see the stock market performance.
Really, the story of the last 5 years in the Indian markets have been that it is the flow of domestic capital which has really gone into the equity markets. And this is important because the wealth that has been created over the last 5 years is all now created by domestic institutions and the domestic public. So it is still a very minuscule amount of savings out of the total household gross financial savings that is finding its way into the equity markets. And therefore, if we think that the current bull market has been fueled by domestic savings, then what it means is that there is still a significant headroom for domestic financial savings to come to the equity markets. We are just at the very early stages of this transformation. The Reserve Bank of India in the last 6 months has become very conservative and have been dissuading the fact that they are very uncomfortable with unsecured loans growing at a very rapid pace. And therefore, we believe that all government policies are now aimed at, they do want credit growth. Obviously, consumers will take credit for consumption, but they don't want something compounding at twice the rate at which the savings are compounding. We believe that the government is sending a signal to the rating agencies that, look, India is very serious about reducing the deficit and reducing the overall debt of the government. Your capital expenditure has increased by 17% and your revenue expenditure has only increased by 6%, right? So that tells you that the quality of expenditure in every budget has improved versus what it was last year. It's really the top line growth which will drive earnings growth. And because revenue growth has been in single digits and we didn't have the tailwind of incremental margin growth because of the high base last year, we've also had bottom line growth which has been in single digits. However, as you will see, we do believe that the second half of the year should be much better and growth should come back to double digits. We could really identify very disruptive and fast growing internet companies which are growing multiples of what the underlying business is growing. And we believe that many of these businesses, what we so call the new age businesses, now offer a very credible investment opportunity. The fact remains that many of these businesses over the next few years will create tremendous value simply because they are aggregating a lot of fragmented demand on a single platform and are compounding at a rate which is much faster.
So bull markets are characterized by sharp corrections in between and followed by equally sharp recoveries. We have seen that in this bull market also. In the current time, we are seeing some correction. Our expectation is as the economic growth and earnings bounce back, we are likely to see a sharp recovery of this correction as well.
However, in the first 5 months, the government has only been able to spend 60,000 crores. So we are running 35% below the intended rate of spending.
So we continue our bullishness on the cyclicals like defense, real estate, and some of the PSUs. Within defensives, pharma offers the best peg to invest in, right?
So I think the era of very strong 25% plus kind of broad earnings growth is behind us. We're going to now see earnings normalizing to the more 13-14% kind of range. And I think this is where smart stock picking is going to matter.
And many of you would have known that luckily for us, our portfolios are very well positioned and have a significant exposure to sectors which actually grew and where there were significant upgrades. Not only this time did we have the general elections, but we also had a couple of state elections which further delayed the government giving out orders for infrastructure across several sectors. Probably Delhi will go for elections in February 25, and then the next major election in Bihar is only in November 2025, which means that the government has clear 12 months to focus on the economy, and there should be no disruptions in the momentum of Capex spending in the country. India is exactly where China was in 2002. We are almost nearing $1 trillion in Capex, and we believe that over the next several years, we should see this trend accelerate in India. We do believe that as the new Trump administration takes office in early part of next year, we will see a significant re-acceleration in the China plus one opportunity across sectors that we are seeing. I hope this monthly communication has been very insightful and helpful for you, as much as we have enjoyed to bring this to you over this several months. And I must say that we got most of our calls right, and for the ones that we didn't, we went back to the drawing table, we reflected and adapted so that we remain agile while being steadfast in our long-term commitment of building wealth for you. I believe we will continue this journey in the next year as well, and I hope to see you on the other side of 2025. Have a great year. Thank you. Bye-bye.